To my left is David Rosenberg, Chief Economist and Strategist at Gluskin Sheff, Stéfane Marion, Chief Economist and Strategist for National Bank, and Beata Caranci, Chief Economist and Senior Vice President for TD Bank. So I wanted to open up the first question on Canada's place in the global economy. Where do you see the Canadian economy headed amid concerns of a global slowdown? Will Canada fare better or worse off than other countries? Beata?
So in terms of how we would fare to other countries, we're going to be sort of middle of the road, better than Europe, but they have set a pretty low bar for everybody, and probably not as well as what we're seeing in the US. So IMF came out with new forecasts yesterday. They made a big splash about the downgrade in their forecasts. Their forecasts are still above us for Canada as well as the global economy. So we only have about 1 to 1.5% growth in the second half of this year. So not a high bar. The drivers of the economy continue to be our old friends of housing, in particular, coming back. But in terms of investment and trade, we don't have a huge amount of optimism surrounding those sectors.
Stéfane?
I think the best you can hope for at in these uncertain times is to grow at around potential, which is our forecast, which is, I guess, similar to 1.5, 1.6 like Beata has. I guess the big difference for all of us is, as economists, it's very hard to integrate geopolitical uncertainty in your models, and we're held hostage by geopolitical events like we've never seen before. So under these circumstances, it's even more difficult. It's not the cyclical backdrop that bothers me. Is the geopolitical backdrop. So for that, we'll see. Every week, every day brings about change. So this is what makes the forecast so difficult. But I would say that the fundamentals that underpin the Canadian economy are quite strong on a relative basis versus other countries. So around potential, crossing my fingers that there's no escalation of the trade war.
David?
Okay, well, from my perspective, we heard that the consensus on Canadian GDP growth is 1.6%. And I think what's important for people that run money for a living, it comes down to probabilities. So I take a look and I think, what are the odds of being below consensus or above consensus? And I think that the fat tail of that curve is really tilted towards slower than 1.6. And the reason I say that is because the one thing that has not changed in Canada over the years and decades is that we really are a torque on global growth. Exports relative to GDP is around 30%. It's 10 percentage points higher than the average G7 or average OECD country. So as the world goes, Canada tends to go. And so I would say that, a week before we had the IMF cut its forecast, we also got the OECD leading indicator for the month of September, which declined for the 19th consecutive month, actually now to its lowest level since 2009, and that's a leading indicator. So I would say just by that alone, given the high trade concentration in Canada, and of course it's really tough to be overly bullish on consumer spending when you're taking a look at household debt to income ratios in Canada actually are higher today than they were at the peak of the US credit bubble 12 years ago, and the financial servicing out of that is actually at its highest level in 2 decades. So you got consumers here, 60% of GDP. Exports, it's hard to really look and see what the remainder of GDP is going to do to offset weakness there. So I'd say that the surprise is going to be to the downside in Canada for the next year.
And based on your forecast, do you see the bank following in the Fed's footsteps?
I'd say for us, well, the Fed has already cut twice, and we have a third one on deck. And certainly the Bank of Canada has taken a more neutral bias. I would say they've been a bit more stubborn in terms of being able to move towards the camp of rate cuts. Interestingly, both central banks define themselves as being data dependent, yet Canada's growth has underperformed that of the US, and the US is cutting and Canada is not. So what I think is ultimately happening is that the Bank of Canada at this time is sufficiently pleased to import the lower yields that's coming off of the risk sentiment from the US over to the Canadian yield curve, which is not propelling them to cut on the short end, hence the deeper inversion and more sustained inversion that you see in Canada. But ultimately, I think they're going to have to be pulled off the sidelines because our forecast is going to, one, we believe, underperform what they're expecting, and two, if you're sitting at 1.5% growth, this is not an economy that's actually towards its potential, especially with our population influx that we're seeing. So we should be seeing better drivers coming through. And one of the biggest, weakest spots in Canada is really what we're seeing on the investment side. It's very low and underperforming, back at levels when you look at intellectual property and machinery and equipment that you saw pre-recession. So you're defining levels of investment that are in the camp of 2004, 5, and 6 levels. So we do need some growth drivers on that front. And really, we do have a housing market that's heavily engaged with a consumer that's indebted. And that is a demand driver coming from the population. But I think to put all your eggs into that basket is a little bit of a risky strategy.
And what's your time frame for the next cut?
Well, I had originally put them in this year, and then the jobs numbers keeps undermining my view. So, and I don't think because the Bank of Canada is starting from a more neutral bias as opposed to the Fed, I think it's more likely they get pushed into next year. So they will likely want to see the whites of the eyes of a deterioration in the data before they start to cut.
Okay. Stéfane?
I don't have rate cuts.
He's the optimist on the panel.
Well, listen, we've had 10 consecutive years of the overnight rate being below inflation. This is unprecedented. So monetary policy is already very stimulative in Canada. You know there's an election, right, coming up, and they're going to spend a lot of money. And at the same time, we have huge fiscal stimulus coming our way. Based on our Taylor rule of the Canadian Bank, for the Bank of Canada, the Bank of Canada should be hiking rates, not lowering rates. So I'm willing to go along with the geopolitical environment. Okay, you don't hike under these circumstances, but you certainly don't cut. I have the U.S. unemployment rate at 3% next year. I'm not going to cut rates in Canada.
Okay. David?
Well,
Next move is a hike, by the way.
The Taylor rule would be telling you that the Fed should be hiking rates too, and they're cutting. So I would say that I am of the view that the Bank of Canada will be cutting. I think that it's hard to really pinpoint when, but I don't think that monetary policy in Canada operates in a vacuum. And you're seeing an increasing number of countries cutting interest rates because the global economy is cooling off substantially. We are in a growth recession, and with a lag, that's going to come back and it's going to hit the Canadian economy. I know it's not today's story, but I think it will be next year's story, and it's going to swamp the fiscal stimulus that we're going to see. So I think the bank is going to cut rates probably, I'm thinking 4 times next year. I think that it's actually a free option because the futures market is not even barely priced 60% of the way for the bank to do anything by the next year. And I think that they will be forced to do something because the Fed is going to continue. This is not, if you notice, Jay Powell is no longer talking about a mid-cycle policy adjustment. I think that he more or less regrets saying that. And now if you're taking a look at the last set of FOMC minutes, they don't talk about the effective zero bound anymore. They talk about the effective lower bound because they're not even clear as to whether or not they'll have to go to negative rates when all this is over. I think they're going to be going to zero. And I don't think the Bank of Canada, this is a case where your assumptions drive your conclusions. I think we're going back to zero. And I think we're going back to a lot of other things by the time this cycle is over. And the only way that the Bank of Canada would want to stay in the sidelines is if they wanted to tolerate an undesirable tightening of financial conditions through the Canadian dollar, which would then crimp exports even more. So I think the bank will have no choice. To me, inflation is a lagging indicator. It's really more about inflation expectations that really should be driving monetary policy. So I think the bank will be cutting. I have 4 cuts for next year in my forecast.
And to talk about some of the bright spots in the Canadian economy, immigration. It has been fueling population growth. How important is this to economic growth? Beata?
Pretty important in the case of Canada in particular. So first of all, you have all your G7 economies with aging demographics. And so your growth composition is going to come out of a ratio between your labor force growth and your productivity growth. Canada's productivity growth has been horrendous, especially in the last year. And so therefore, more of that growth is going to come off of that labor force growth. So if you think of it as a ratio, as your population is aging, you would typically have about 2/3 your growth off of productivity and 1/3 off of labor force. But our metrics are kind of turning in upside down. So if we can't get the business drivers on the investment side to really kick in, you have even more dependency coming through your labor force growth as the means of having basically instead of lower cost of capital, you're going to have it through the lower cost of resources. So it's particularly important for Canada. It's been particularly important for our housing market, which has been the one area that, I always say, there's that old expression, you can always count on 2 things in life, death and taxes. And in Canada, it's death, taxes, and a rebound in the housing market. because every time it gets compressed, it just seems to come back up. And I think this is where economists tend to underestimate that demographic dynamic, how it feeds through the economy. Japan's on the polar opposite end of that spectrum, and I think Canada is proving to be a proof point that you allow in population growth that's 2 times the growth of what you're seeing in other countries. It's going to feed through to the consumption and the housing cycle. And so that is now one of our biggest strengths relative to other countries. But we still haven't solved the issue on our investment in productivity, which is really important for the future of growth, especially as the economy becomes more digitized as we go forward.
Stéfane?
Well, you can let David go first because he keeps on picking my forecast. So let him go first and I'll pick on his forecast. David.
All right. Well, you want to see 2 economists fighting in a soundbox. That's what we all. So, but we love each other. So let's just say that this is what's interesting. Population growth in Canada is running at 1.5% year over year. GDP is running at 1.4% year over year. So it's the classic case of lies, damn lies, and statistics. So there's this aura, or there's this appearance of the Canadian economy doing well. But actually, in real per capita terms, this is where I would differ. In real per capita terms, Japanese economy is actually growing. In real per capita terms, the Canadian economy is actually contracting fractionally. But it is the primary source of growth. There's no doubt about it. But the way I look at the Canadian economy right now, it's really quite bifurcated. I call it the triple C economy. There's crude, condos, and cannabis. And when you actually take a look at, there's 40% of GDP, which is housing, which is basically cannabis and government. And of course, everybody talked about the numbers that came out on Friday, and a lot of that was public sector. But when you're taking a look at the public sector, housing, and cannabis, that basically is growing 3% year over year. The other 60% of GDP is growing 0. So I'd actually say that the Canadian economy right now is actually, fundamentally weak. And it comes down to the comment that you made earlier, which is why if the economy is so weak, isn't inflation melting? I mean, it seems like Canada is the only country in the world where the Phillips curve hasn't rolled over. And it might be because potential GDP growth is very weak. And that's probably one of the reasons, the structural impediments, the lack of competitiveness in Canada, that has shown up actually. The fact that we've had 11 consecutive years of a current account deficit really tells you something. And with a cheap Canadian dollar, it tells you something about the homegrown competitive problems the Canadian economy has. But I would say, just back to the point that absent population growth, the Canadian economy is actually contracting right now, fractionally.
So how do you say this is where your assumptions drive your conclusions? I would argue that our immigration policy is critical to our growth. I would argue it's the best immigration policy in the world. I would argue that our population growth is concentrated in age cohorts that provide much better transmission of monetary policy. So immigration accounts for 80% of our population growth. 2/3 of our immigrants are prime age workers. That's why we have the highest prime age employment to population ratio among the OECD, where we are at an all-time high. 50% of our immigrants are millennials. I'm based in Quebec. Without immigration, there's no population growth for millennials. So that drives your demand for housing. That is critical to get the economy going. And at the same time, these people are finding jobs in the service sector. How do you measure productivity in the service sector? So productivity, the way we look at it as economists, is a residual. So let's look at it backwards. We had record profits, record low unemployment, stable inflation. Clearly, productivity is mismeasured in Canada. So I would argue that maybe potential is higher in Canada, and because of that, we might be misreading the sources of growth and the outlook for the Canadian economy. So immigration is critical, not just for population growth, household formation. It reshapes the Canadian economy in the service sector, and I'm sure our productivity is much better than what's being advertised right now.
I got a question for you. Why has inflation come down more rapidly in Canada then? Why is it stuck at 2% if potential is so much higher?
It's stable.
Well, in addition to immigration being a bright spot, we're seeing a recovery in the housing market. which have impacted debt levels. Do you believe that Canada's record high household debt levels will be resolved?
Well, it'll get resolved, but usually it's a recession that resolves it. So there's two ways it gets resolved. One is through a recession because your credit demand completely collapses, and we're not there for certain. What I think the Bank of Canada is hoping is this notion that you grow yourself out of your debt, meaning that your credit growth slows or grows at a slower rate than your income growth, which is actually what has been happening in the past year. However, the housing market is heating back up thanks to the import of low yields from the US, not because of the Bank of Canada's policy setting. Probably we would not be seeing this rebound in housing if not for the fact that we've had these yields drop 100 basis points because of risk and coming through the US segment versus the Canadian setting of the policy rate. So overall, you have a situation where I think, as we go forward, we have an economy that will continue to propel this credit growth until you end up in a situation where your jobs are compromised, which is your leading indicator for a rise in delinquency rates and the slowdown in credit growth. So we had this period of stability of debt to income, and it's probably very likely we're going to see this re-acceleration kick in the next couple of months. And just not to knock the housing market, because I think when you think of Canada, you think, oh, heavily indebted household sectors, which is absolutely true. But remember that the housing segment does fuel the consumer segment. That is a reflection of what Stéfane was saying in terms of population and immigration dynamics. Those population statistics inside of the cities are growing at a rate of over 2%. This is phenomenal. And the difference between Canada and the US, obviously, is we have a much more concentration of cities in a smaller segment of the geography. So we have 60% of our population that resides within 200 kilometers of 5 cities, and that compares to 1/4 of the US population. And so there's these demand pressures that settle in very in a unique way in Canada relative to what you see in the US. And I would say if you think about housing in the US as a comparator to Canada, the biggest disappointment we've had on the US recovery and expansion has been in housing. If the US can engage its housing drivers, and that feeds through the consumption drivers, we would be looking at growth closer to 3% in the US versus middling at around 2%. So what Canada has as its strength, other countries have not been able to engage to the same degree, and it's directly related to this immigration and population influx. Stéfane?
Beata's right. 1 million jobs created over the past 4 years. 2/3 were in only 3 metropolitan areas, Montreal, Vancouver, and Toronto. And we've never seen this concentration of job creation in only 3 metropolitan areas. Just to demystify a few things, debt to disposable or household debt to disposable income. You look at the official figures, they say 178% debt to disposable income in Canada, 90% in US. They're not comparable. In Canada, the household sectors includes non-corporate businesses. So let's make things clear on that front. If you adjust the Canadian figures to make them comparable to the US, Canada goes from 178 to 160, and the US goes from 98% to 130%. The gap is not that wide. Clearly, if we have a higher homeownership rate driven by this immigration policy, it's hard to bring down those debt levels, which are high by historical standards, but not alarming if you compare with other OECD countries where the social safety net is relatively generous. So the way you bring it down going forward, obviously rates could be adjusted, there could be an economic slowdown or not, but I would not deem these ratios to be alarming right now. Compare with Australia, it's over 200% on a comparable basis. So my point here is that the good news is they have stabilized through a number of macroprudential measures that have been introduced in recent years. So if we stay at around 160% debt to GDP, debt to disposable income, without a global recession, I think things are manageable.
David?
Well, look, I think that the stretched balance sheet is one of the reasons why, despite how great the immigration story is in Canada, let's look at year-over-year retail. Let's look at year-over-year retail sales growth. Year-over-year retail sales are running 0%. So I think that, and by the way, the debt problem in Canada is not just a Canadian debt problem, it's really a global debt problem. And that's one of the reasons why, despite all the dramatic easing in monetary policy, this proved to be globally the weakest economic expansion, notwithstanding the duration on record. And it's because global debt is acting as a huge tourniquet on aggregate demand growth. The one point, I'll just come back once again. I'm not claiming that immigration is a bad thing. It arguably is a good thing. But the question is that you don't measure a country's standard of living by GDP growth. You do it by GDP or GDI per capita, and that is not growing in Canada. And the problem is that there's been no capital deepening in this country for a decade. Productivity growth, I would agree, very difficult to measure in the service sector, but that's also true in the United States. So let's just say that productivity is inherently difficult to measure, but that's just true in the United States. So we'll take that imperfection south of the border, and measured productivity growth in the US is running at 1.7%, 1.7 year over year. And so they're getting productivity growth, they're not getting population growth, we're getting population growth, but we're not getting productivity growth in this country. And so we can sit here and talk about how great housing is, but I'll tell you, housing to me is just another consumption good. You don't have any link between housing. Now, housing might create better citizenry, but there's no link to productivity. There's been no capital deepening in this country, and we could have a whole debate about that. Housing is just a consumption good. It is not a capital good. And the funny thing about Canada, when I said the triple Cs, right, what did I say? I said cannabis, crude, and condos. I think we're the only country in the world. I mean, you go to the United States, and every single month when you look at the housing start numbers, typically there's twice as many single-family units being built than multifamily. And that's actually got a much higher multiplier impact on GDP if you're just looking at housing in your model. In Canada, there's 3 times as many condos being built every single month than there are single family. And you start wondering, well, you know, who exactly is buying? Who are buying these homes, right? Are these Canadians buying these homes? Most Canadians can't afford to buy these homes, or these condos, I should say. So anyway, that's a different issue altogether. But I would say that to be talking about in Canada at a time when residential construction as a share of GDP is almost at a peak. It's not like it's 3 or 4%. You know, to be talking about I'm bullish on Canada at a time when housing as a share of GDP is already well above the historical average. To me, what you want to see is you want to see what's below the historical average, which is capital spending. You want to see a capital spending cycle happen in Canada. And there's no signs I'm seeing that's taking place.
Well, I agree, right? That was my very first statement. What's the missing link in Canada? There's so much emphasis on housing, even in the political platforms that we're seeing out today for elections on Monday. But you're not seeing the emphasis on how to get the investment side rising, especially with the energy sector not being that major contributor anymore. But just a little bit of cautiousness in terms of, I think we knock Canada's housing sector way too much. If you look at the construction levels relative to the population, remember your base is this massive influx of people into the country, into education system, into skilled level jobs, Stéfane mentioned, and into the core age group of 25 to 54, which is where you get your ramp up in housing. That construction to population metric is not showing bubbly indications. It's not even at levels pre-crisis. Relative to the US, is it elevated? Absolutely, but my point is the US is too low, and relative to Canada being too high on that construction metric. The problem is our supply isn't keeping up with the influx in demand, and that is the bigger issue. The reason the condos are getting built because it's the cheaper price point, and we have density problems. Like I said, we have a concentration of the population in very small square footage of areas across the country. And what I've been saying is, like, Canada is going through a maturity spectrum in home ownership and housing that we will start to look more like many major American cities where we need to get our rent ratios up, not our home ownership ratios up. And so the affordability and how people think about housing, we need to see that migration more to being okay with renting as opposed to ownership rates, which are already at 70% and are just high relative to everybody else. Clearly, it's still affordable. People are still getting into the market, but they've moved down into that condo segment. The reason the US, I think, is underperforming so much on housing, where we would like to see more drivers, is while Canadians have a lot of household debt, mortgage debt, on the flip side, your main buyers in the US have a lot of student debt and other leverage that is preventing them to get into those housing units. And on top of it, they don't have the legacy of wealth from the past, like the Canadians do, to have parents and others propel them into the market. So there's completely different drivers at work. And I think it gets mischaracterized in Canada that there's, you know, housing doesn't create value. Of course it creates value. People are buying these with jobs who create value. And that creates a consumption cycle and other factors that create value in the economy. So don't knock it. A lot of countries would love to be in that situation.
We
Shelly,
just-
I would argue also that in the 21st century, deepening your pool of human capital is as important as deepening your pool of physical capital. We have an historical gap with the US in terms of the share of the population that has post-secondary education. That enables you to adjust to globalization, technological changes. This is my cue as to why our potential GDP might be higher. So again, human capital is our way of deepening our capital, pool of capital in the country.
Well, we've run out of time, but I just really want to quickly, what is your probability of a recession in the next 12 months, David?
Uh,
Real quick.
80.
80?
30.
30?
Yeah, I would put it between 30%, 40.
80, 30, 30, and 40. All right, thank you so much for joining us.
Thanks.